When you pose the question, is investing in stocks basically gambling? You tap into a compelling and widely debated issue that resonates with both seasoned investors and financial novices. The answer isn't just black or white, but rather shades of intricate grays that require a deep dive into the nature of both investing and gambling. Let's start by unpacking what it means to gamble. Gambling is fundamentally a game of chance. Whether it's rolling dice, betting on a horse, or playing the slots, the primary characteristic of gambling is the high level of risk and the reliance on sheer luck. The gambler puts something at stake, hoping to predict an uncertain outcome, and quite often, the odds are not in their favor. This thrill of potentially gaining a large reward from such uncertain prospects is what makes gambling exciting, and for many, addictively risky. Investing in stocks, however, tells a different story, a narrative that is more complex and intertwined with the dynamics of the global economy. At its core, stock market investing involves purchasing shares of a company, thus owning a part of that business. The hope here is that the company will grow and perform well over time, increasing the value of your shares, thereby offering you a return on your investment. Unlike gambling, investing in the stock market is not primarily about luck, but about making educated decisions based on research and analysis. One could argue that the unpredictability of stock prices, especially in the short term, injects a level of risk that could be likened to gambling. Stock markets are influenced by a multitude of factors: economic indicators, political events, environmental conditions, and more. This complexity can make the markets seem as unpredictable as a roll of the dice. For instance, even the most thoroughly analyzed stock investments can be subjected to sudden downturns in the market. However, this is where the distinction becomes clearer. Investing, unlike gambling, provides you with tools to manage and mitigate risks. Investors have access to a wealth of historical data, financial reports, market analysis, and expert forecasts, all of which are designed to inform and bolster investment decisions. Sophisticated investors use these resources to strategize their investments, diversify their portfolios, and hedge against losses. Moreover, investing in the stock market is intrinsically linked to the real economic value created by companies. When you invest in a stock, you're betting on the company's future success based on its current management, business model, industry position, and growth potential. This is fundamentally different from gambling, where the outcome relies purely on chance and probability does not necessarily favor the gambler. The time frame is another crucial factor that differentiates stock market investing from gambling. Gambling is often a short-term activity, where the results are immediate or occur within a brief period. Stock market investing, on the other hand, is generally viewed as a long-term endeavor. Long-term investors reap benefits not just from the appreciation of stock prices, but also from dividends, stock splits, and other forms of shareholder equity. Over time, despite the ups and downs of the market, investing in a diversified portfolio of stocks has historically yielded a positive return. Education and mindset also play pivotal roles in distinguishing investors from gamblers. Successful investors are often those who continuously educate themselves, staying updated with market trends and economic shifts, and thinking critically about where and how to invest their money. This educational aspect underpins every decision in the stock market, and is starkly different from the often impulsive nature of gambling. Another angle to consider is the emotional aspect associated with both activities. Gambling can often be driven by a rush or a high, chasing losses or pushing one's luck too far. This behavior is typically discouraged in investing, where the ideal approach is calculated, calm, and devoid of emotional decision-making. Effective investors often have a plan or a strategy in place to guide their investment decisions, and they stick to this strategy, adjusting only when necessary based on rational analysis, rather than emotional reactions. While it's easy to see why some might view investing in stocks through a similar lens as gambling, both involve risk and uncertainty. The strategies, objectives, and outcomes are fundamentally different. Investing is built on the foundation of seeking long-term growth and capitalizing on the economic value generated by businesses, using tools and strategies to mitigate risks and maximize returns. In contrast, gambling hinges on chance, with a significant focus on short-term gains, often at high risk. Thus, When you ask if investing in stocks is basically gambling, you are touching on a fundamental misunderstanding of what it means to invest in the stock market. This exploration of the nuances between the two can transform a simple question into a profound discussion, emphasizing the importance of understanding and respect for the complexities of financial investments. By viewing investment as a disciplined and educated approach to growing one's wealth, we can appreciate it not as a gamble, but as a calculated decision to participate in the financial successes of industries and the economy at large.